Hey, morning everyone. Welcome to the room. As you know, trading futures does involve risk, not suitable for all investors. Information in the presentations for educational purposes. It's not a trade signal service, not intended to be financial advice. So we got another Fed meeting tomorrow, or today and tomorrow. Meeting announcement will be tomorrow, so which means today will likely be a little bit on the slow side. We've got this nice inverted hammer on the daily chart yesterday. So I did buy some puts at the close, just some for Friday's expiration, some for Monday's expiration around it was like 415, 414, I think. Yeah, we're right at just above 415. So those were the at the money ones. See if we get a little bit of a pullback after the announcement on Wednesday or on Thursday. But you can see even on this next retracement, like we didn't dip very far on this pullback, so still pretty bullish. More basing it off of kind of this double top from back here, triple top if you want to call it that. So we'll see what that brings. If I go out to a weekly chart, you can see that all-time highs down to November. Oh, let's see, not all-time. Um, go out even further here and go like that. There, now you can see the all-time high to October lows. That's the 50, the 41.55. It's been up there on the chart for a long time. And as far as gaps are concerned, we don't have a ton, but we do have, we're starting to close in on some from quite a ways back. So like recently we don't have a ton, and one down here from last week, but if we start to go up, we're starting to see some from like back in last year, prices that we haven't traded at since last year, and then the ones below us are just bits and pieces from this year. See, intraday yesterday had a couple of 1 minutes, and there was no 15-minute opening range breakout because we filled the gap in the first 15 minutes with this first bar. See how you can kind of see the dotted line as the start of Monday, and this first green 15-minute bar had a little bit of a gap down, and then within the first 15 minutes rallied and traded at the close of the prior day. So when you get that, I just pass on the 15-minute opening range breakout. Her breath is decently negative. I would wager that we move towards 1-to-1 as the morning goes on. See how this initial reaction is off of the first 15 minutes. It's nice when you get a break below the low price of the highest bar in the rally. So that's the low of the high bar, especially when it's an inverted hammer like that. Or if you get a break above the high price of the lowest bar in the pullback. That's the high of the low bar. So HLB or LHB are kind of those two little acronyms. Really the only reason I bought Friday and Monday puts is that if we were to be like the Friday ones I would more than likely close out Thursday at the close. And so having Monday in addition allows me to see the open on Friday. And if we gap down, it just buys me a little bit more time to say, okay, we're moving down on Friday. I'm going to hold these into the close and still have an extra, technically, 3 days because you got the weekend. So it just buys me a little bit more time to see a down move and gets it a little bit further away from a planned exit is really all. I guess I could have bought both on Monday, but I usually mix it up just a little bit. If I would have gone out like 3 or 4 weeks, um, they would have time, more time decay built in, uh, well, depending on the strike. So you got the intrinsic and extrinsic value. How much is it in the money versus out of the money? But that time component can add a lot of cost to the option. So you might be paying an extra couple of bucks if you go out an extra couple weeks, and the move more than likely wouldn't, like the daily time decay wouldn't be that extreme. You wouldn't be losing a ton of money each day if you bought them with a couple week expiration, but it's just a little extra risk that you're taking on. So for that reason, since the catalyst, the reason for the put hedge is Wednesday afternoon, like that's the time, the event that I'm using them for, their purpose. I'm okay going super short expiration because the goal is not to hold them through the weekend and catch a big 3-4 week downturn. It's just to capitalize on a potential, drop after the Fed meeting announcement. And if instead we pop, if we rally, then they don't cost much, so there's really not as much risk. Even though theoretically you could buy out 6 months, spend a lot more money on the contract, and still have it be valued quite a bit if it goes a little bit against you or the same amount against you. You're putting more capital at risk into the position. So a kind of an initial little um, move down off of the gap down, but not accelerating that move down. And that's what's important when you're looking intraday. Well, I guess anytime really, but when you're looking at important levels like the high and the low for the day, if the market's going to retest that, or if it's going to come up to the close of the prior day, or the 30-minute high and low, I'm looking at how does the market react. If we're coming up to the high, let's say we rally to, let's say the low of yesterday. That would be the next closest price. We've got the high of yesterday, the low of yesterday, and the close of yesterday. This 41.82 and a quarter, if we rally and come up to yesterday's lows, I would want to look fairly closely and see, do we just come up to 41.82 and roll right over? Like, are there sellers there waiting to push the market down? Or do we just come up to 41.82 and then immediately keep going? In which case, now, a pullback to 41.82 could then be buyable. So how strong is the support and resistance as you come up and down, back into a prior day's range or retest the day's high and low? So going to, like today, for instance, we had this first move down, a couple of bars sideways, and Now we're back at lows for the day, not a immediate rip to the downside, but really not a lot of support to take us much higher than just a little bear flag initially right off the open. So, and now seeing us break this low and kind of tick, tick, tick down fairly quickly, you can get kind of a feel for the pace and how much support there is at lows. Some days you'll kind of come down, you'll break lows by just a tick or two, and then you'll rally pretty big. And then you might come down to that low of the day again and touch it to the same price exactly, or come down, maybe break it by a tick or two, and then it's immediately bought up and pushed up. Versus coming down to lows, breaking it, and then boom, dropping 2 points. Now you can see that there's not much support there. So looking for a short. And so those are kind of like the inflection points, those support and resistance areas. Highs, lows, close that I start with on the day. You can turn to the extended hours if you want, just briefly in the morning, just to get an idea of, okay, where did we trade overnight? And that's for the reason I leave the volume on down here, because I can, if I do flip that on, I can see here's the prior day's close. Okay, they got the horizontal line, um, or that's the low rather. The close was just up a little bit higher, about here. And I can see we're trading above the prior day's close or below the prior day's close for the most part in the overnight session. And then the higher volume bars here are going to be the trading hours, NYSE session, whereas the lack of volume is all the overnight. And then I don't really look at it much after that. If you do have questions, feel free to use the type them into the chat box there in GoToMeeting. Later this afternoon, I'm doing a guest webinar on trading psychology and other trading hacks or tips, I guess, if you want to say. I'll put the link in the chat there as well. And that will be 6 Eastern time. On the Tuesday, the Wednesday of the Fed meeting, I don't trade, which most of you know. Tuesday before tends to be a little bit on the quiet side. The last couple of Fed meetings, instead of getting a huge sell-off after the meeting, we've actually rallied a little bit. Not so much on Wednesday. On the last couple of Wednesdays, we've closed pretty negative, but haven't had a huge slide after that. Prior to the last couple of meetings, we were sort of selling off into the meeting. Last couple of meetings, we sold off into the Fed meeting and then rallied afterwards. Prior to that, we were getting a much bigger slide after every Fed meeting. I think you're going to have some of these tech companies just kind of go gangbusters with their ability to, like with all the AI stuff that's coming out. Some of the companies that will, so many companies will just become extremely efficient and productive with the way they can come up with ideas and iterate and kind of optimize some of that stuff. So I don't think tech is dead at this point. Still waiting for kind of a crypto um, purge, if you will, kind of like we had with the in the early 2000s with a lot of the tech companies. You know, there still is a lot of junk out there as far as crypto companies, but I think you have the same thing. You know, some of these companies that are, or some of these coins, cryptocurrencies that are basing their coin on more of a tangible product, or like attaching it to some sort of utility, will flourish and evolve and be around for a long time. So there's some really cool ideas out there, and everything from like storage, encrypting your files, stuff like that. That maybe the purpose of the coin is not to have it go 200x, but the value of the utility makes the coin valuable. So if you can brace yourself to expect the unexpected, then you'll never be too surprised. When things are going beautifully and you say, man, I can't imagine how it could turn, that can be a dangerous spot to be. There's certainly things you can do to your limit any kind of damage and catastrophic um, a catastrophe, I guess, to wipe you out. If you're growing your account and you're going from 2 contracts to 4 contracts to 8, I'll come back to that in just a second. We're going to have a 15-minute low is 66.50, and the 15-minute high is 77.50. So we're a go for the 15-minute breakout. Get those in, and we'll see if they trade. I'll mark it temporarily here. This is the 15-minute low, 15-minute high, and we'll see which one fills. On these Tuesdays before the Fed meeting announcement, not really expecting a big move. Today could certainly be a little bit different, but the last handful, if I go back here, let's see. So the last Fed meeting Tuesday, we filled the gap. One before that was a 20-pointer. One before that was a 20-pointer. And then we kind of got into the quieter Fed days. Filled the gap, filled the gap, filled the gap. So the last 2 or 3 Tuesdays before the Fed meeting and days following have kind of been that little bit more exciting and active, I guess. So we'll see what today brings. You can pretty quickly tell as you get toward. We also have, I believe, jolts at the top of the hour, and there was one other news report. There were 2 reports coming in the next 15 minutes, so not surprised if we have a little bit of a pause before those top of the hour news announcements. It was, or is, let's see, jolts and factory orders, top of the hour. So I just set those orders and leave it. We talked a little bit last week about setting up the brackets. If you do a bracket order, so if you put in 41.66.50 as your sell stop and you have a bracket active when that price is triggered to go plus 20, minus 20, and then the order fills, and so your target goes out there, and then a minus 20 stop goes out there, then you could just come in and adjust the stop to be the top of the candle. So like this candle's only 10.5 points, then you could bring, if it moved to the downside, you get your plus 20 goes out, your minus 20 goes out, then you can move the stop, and then you can still have another order on the other end. So if you had one contract short on the sell side, or the like covering the position, the buy side, I guess in this case, at 77.50, you'd have the stop plus a resting order if you wanted to reverse it, if it was going to go to the downside first and then turn around and go to the upside. Otherwise, if you just put in single orders, then when 66.50 gets triggered, you have to manually go in, put in the target, and then if you only have one order as your stop, like if you put in 66.50 and a as a sell and 77.50 as a buy, then whichever one doesn't get filled ends up being your stop. And if you wanted to reverse, you'd have to add a second contract manually. So either way, there's a little bit of kind of manual clicking to make it work if you're going to reverse it. But otherwise, it's about as simple as you can get for um, trade execution. So if you're newer to trading or not as familiar with the trade ladder, certainly practice on the sim trade ladder just so you don't make mistakes. And there's a little inverted hammer here. Not going to be in it in time. I was looking at this little inverted hammer here on the highish tick. That would have been worthwhile to get a short underneath. So see on this 1 minute chart here how this tail on this invert is kind of like a doji, sticks up above this high, and then it kind of makes a double top here. It didn't quite make it to the 50%, but it's fairly close. And then, but more importantly, look at the nicey tick. See how it sticks up here? The nicey tick on this chart on the left sticks up higher. That's nice when you get a spike in the nicey tick and the spike in the tail as well. So get initial, see how quickly the next candle moves down. So you know all of a sudden your stop is just about at break even within 30 seconds. I mean very very quickly. So nicey tick is super helpful. Yeah, that's a good point, Mateo. Since I've been doing a plus 15 minus 4, like when on the 15 minute when price gets to plus 15, I'm moving my stop to minus 4. You can set like in Tradevate and a lot of platforms, you can set it so that when price gets to plus 15, your stop automatically goes to minus 4. So like if I put on the trade and then it's been an hour and a half and the morning session is kind of over, then I might go for a bike ride or go leave, and even before the trade has finished. And so that way, it will automatically adjust. As far as the AI goes with trading, um, There's definitely been a lot of AI already in the trading space, so it's not really anything new. But you still have to have the human input of creating or kind of managing the strategy. So it's not like ChatGPT is going to come up with a trading strategy that will work 100% of the time. So it could help you optimize some things, perhaps, or could um, maybe run through your trade log. It's in a similar way that a lot of these trading journals can go through your trades and find um, similarities or break-even points, or help you optimize your trading. So with the 1 minute, if you're trailing your stop down on each candle, when you get a move above the high of the low bar, like I just mentioned earlier on the daily chart, this green bar is that move. This candle broke above the high price of the lowest bar in the move down, and then that's where your exit is. So not really a surprise that it's not a huge move, just because of today being the Tuesday before the Fed meeting, but that's kind of the perfect example where you've got a corresponding high tick or high-ish tick. This isn't the high of the day, so um, not a high of the day, but a high nicey tick with a tail on the inverted hammer. So you're going short in high ticks, long in low ticks, and that concept applies for retracements as well. Anything really. You want to double check your nicey tick so that when you're shorting, you're also in a relatively high tick, and when you're going long, you're in a relatively low tick. I'm not getting super, I guess, aggressive on the 512 here, just because we're kind of in this range between the 50 and the low of the day. And if you look at the 512 tick chart, it's kind of a jumbled mess. If I came in here and drew a retracement long, okay, you broke the 61.8 down here, then you say, okay, well, let me come in and draw a retracement short. You say, okay, oh, well, I broke the 61.8 here. And so when you have a back-to-back set of failures, meaning you broke the 61.8 by at least 2 ticks, that makes a failure of the 61.8, then you don't want to trade kind of through the middle of that range. So you got to be a little bit extra careful there. And coming into today, knowing it's the Tuesday before the Fed meeting, also a reason to be a little extra on the conservative side. So outside of like the Fed meetings, so that Tuesday, Wednesday, uh, what else? When it's like a 3-day weekend, that following Monday, um, I'd kind of take that a little bit, ease back into it slowly. Half days, like if it's early close, like the day after Thanksgiving, I don't bother trading. There goes the 15-minute. Let's see what that turns into, if anything. So there's not a whole lot of days that you need to really be extra cautious on. Expiration Friday, those 4 Fridays a year with futures expiration, I usually either don't trade it or trade it pretty lightly. Um, and coming off of that rollover week, I'm usually already being a little bit extra diligent, I guess, in my trades that I'm picking. So, you figure 52 weeks out of the year, maybe you trade 46, 47, 48 of them. I mean, that's still, let's say you traded 40 weeks out of the year. That's still a lot of weeks by the time you add up all the Fed Wednesdays. There's every 6 weeks you got a Fed meeting announcement, and so yeah, it's okay to take breaks. It's okay to plan ahead of time for a no trade day, or to come into the day with that mindset. Just helps keep the flow as you go throughout the year, so you're not getting burnt out and not kind of like spiraling or snowballing yourself into a rut. So we got a couple minutes. I'm not going to put on any trades here until we get through the top of the hour. We're getting kind of close. This retracement is a little bit on the high side. Like the 50% is a little bit far away. Not that far away, but I would prefer when we get to these situations where you have a resistance point. What am I? When the 50, it's nice when you can get that to line up with a support or resistance level. So if we had traded a little bit lower and then we bounced, that's a nice kind of confluence, if you will, but it's pretty close. When you're within a point of a price level, that's usually enough to consider it traded. Like this, how close did we get here? 71 and a quarter, and this was 41.72. So basically, I'm considering that 50% traded as we move down. So that's why I left this 50 up. It's not always perfect to the tick. So, and the reason for waiting to put on a trade when you get a number coming out within like 1 to 2 minutes is just so it doesn't spike through your stop on a sporadic whipsaw move. Outside of 2 minutes, probably okay. You get inside 1 minute, it's not really enough time to get in, get a first target, reduce your risk, that kind of thing. See this here move down 2 points. Not quite enough for a 3-point first target before turning around. So if you get into a trade right before a number, you risk it kind of maybe starting to go your way a little bit, but then can rip through your stop. Even if it ends up going to the downside, you'll see this like tomorrow in the afternoon when Jerome Powell starts speaking. You can get these crazy whipsaw moves. And even if the market ends up going in the direction you thought it was gonna, or you had a position in, it's so difficult to stay in that trade with all the whipsaw price action. It's better for my trading overall to just not trade on that Wednesday. I do the puts ahead of the meeting and then call it good. Then you can, get away from the screen, recharge, refresh, and then you come in Thursday more focused and prepared versus being frustrated and maybe having taken a loss on Wednesday. It's like the risk of gain, the possibility of gain is not worth the risk of loss and carrying over the mental headspace from that. Here's another at 7 o'clock bar on the 1 minute chart. Same thing that we saw back here. 65.50 is the next short. And that 15 minutes just kind of, we'll just let it do its thing. I will move, let's see, so I will take this and move it down. This is our target for 15 minute, and then I'll mark the 30-minute low. Which is there. Yeah, the 15 minute I take every day so long as we don't fill the gap. So today we did not fill the gap. Therefore the 15 minute is a go. The 65.50 is just above the bottom of the 30-minute range, but it's probably close enough. We're getting a bit of a bear flag, so we'll probably break to the downside before 65.50 trades. And that's the whole point of the 15-minute breakout is that if the market is not getting a full retracement, let's say we break early and start trending, you have an opportunity to get into that trend without having to scramble or chase it, and kind of gives you a little peace of mind that, okay, if we open up and we start trending, or if we have a big gap and then we start filling the gap right away, I can get in on the 50 right after the 15-minute candle closes and ride that trend. Nothing worse than feeling like you're scrambling or trying to catch up or chase the market. Not a position you want to be in. Still have a way to go for 15-minute target, but just one of those you kind of set it and forget it. But this 1 minute, this inverted kind of doji hammer here, so far those are the two that are kind of the standouts today so far. If we close today a big red candle, I may take off 1 or 2 puts just to guarantee a winning trade, or a winning position, because that reduces some of the risk and it locks in the profit. I wouldn't take off too much more than that because the whole point is to hedge for the Fed meeting. But I guess you could say, well, if we get the big sell-off coming into the meeting, which has happened, we were just talking about that. There was a meeting not too long ago where we put on the puts and the market sold off hard in like the 3 or 4 days leading up to the Fed meeting. So by the time you got to the meeting, it was like, wow, these things are already way in the money. So taking a decent chunk of profit there is definitely worth it. So yeah, I guess it would depend on how much of a big red bar, but typically the day after I put them on, if we get some sort of bearish move, let's say I buy them for 250 and they go to 5, Like if the option contract doubles just because of the size of the move. It doesn't have to be a huge move to get a couple $100 per contract um, move. Yeah, then I'll take a couple off just to lock in some profit. Yeah. So 15-minute looking all right. 1-minute chart. So then we talked about the 15-minute able to get you into a trade when you're not getting much of a bounce. Same goes for the 1-minute. When you're selling below the low of the high bar, we just had this drawn up here. We didn't trade at the 65.50. That 1-minute can get you in a little bit earlier without a bounce. Yeah, you're getting in on the momentum to the downside, but that's what you are looking for, to get in with the momentum. Whereas on the retracement, you're looking for a little bit more of a bounce, a reprieve to get in. So that's a nice pairing, I guess. Same thing with like swing trading of puts and the day trading side. It really doesn't take that much effort to put on a put position. And then you have that kind of as a safety net. And you can just focus in on day trading. And so being comfortable not placing a trade, or just that feeling of, okay, I don't have to rush in, I don't have to chase, I don't have to frantically try to catch the train that's leaving the station, as we like to use train analogies a lot. Um, that just makes your trading so much better and makes you think so much better. You don't have to be frantically trying to make erratic moves. Down here in a low tick. 08. The low price ended up being at 09. The low tick was actually at 08. So not a perfect alignment. Well, this is moving kind of quick down here. Let's see what happened with that Jolts number. Doesn't look too terrible. Factory orders was the other one. Right. Yeah, nothing. Factory orders actually rose. So we are into -4 territory on the 15-minute, meaning your stop can go from the opposite side of the candle here up at 77.50 down to break even -4. And closing in on 20 points already. See if we make it there. So these last couple of Fed meetings, well, Tuesday before, have been a little more active than, or a little more movement. I wouldn't necessarily say active. The maybe a one or extra 1 minute opportunity in there, but needs a 46.25 to print to get the 46.50 filled. If you are practicing on a sim account, take the price level that you want to be filled and move it down a tick, or like add an extra tick, because usually on a practice account it's just going to fill you when price touches it, whereas in the real world, first in first out, you need price to trade through your order to run through all the orders at that price level. Sometimes you get what we joke and call a magic fill, when price just comes down and sits on your order and fills versus trading through your order. But that might be, I don't know, 1 in 20 case, 1 in 40. Doesn't happen that much, but so if you're on a demo account just learning, that can sometimes help your numbers be a little more like the real life environment. So let's see if we'll get there. Getting a couple extreme low ticks here. Be really nice to get this 46.25 before you get a bounce. Blow on it. Couple more ticks, little guy. There it goes. Cool. Well, that was plus 20 and not a lot of time. And not a lot of hubbub or like futzing around. Low tick here. Let's see. We got 10 more seconds. I'm going to take a long above this hammer here. 49.50. 49.50. It's kind of a big candle, but let's see. It is the low tick of the day. Got our plus 20 locked in. You could say we're due for a little bounce. Breadth and advanced decline line very negative. That's quite nice. See if we can get a little pop here. There we go. So in another 20 seconds or so, should be able to move our stop, hopefully. Now this is a little bit of a stretch just because we've been trending down so hard, but seeing these multiple low ticks, kind of worth a stab at it. And we're going to be moving to 47 as the stop in 3, 2, 1. There we go. So 47. So immediately, or pretty quickly, after you can get into a 1 minute, just like we talked about earlier, being able to tighten your stop. I mean, that's the real benefit of the 1 minute time frame. It moves so quick that you're able to tighten your stop really fast and take risk off. So yeah, it starts with a 3.5 point candle, but as soon as the next candle closes, so long as it breaks above the prior candle, you can take some of that risk off. So not on the 512, we're still in the risk of rolling over territory. We haven't broke a swing high. We really haven't broke the 61.8, but we'll see here. 48 will be the stop in 3, 2, 1, 48. Okay, we're right there on top of it. 47.75. There it goes. All right, so not much there. Worth a shot though with these low ticks. Probably means we'll roll over and get um, maybe a little bit of sideways here before getting the bounce. So plus 20 on the 15 minute, and then little stop out on the 1 minute there. Probably won't do a ton this morning on the retracements unless we really start to get some clean looking moves. I mean, this is the swing high back here, and you have this move down, and you've got these little highs in here. We kind of talk about being to the right or left of the low point. So if I hold my cursor here above the low point, all of these little highs are to the right. So this still remains kind of the swing high to break, the more important one. These little swing highs are not as strong because they're to the right of the low here. So we'll see if we roll over or not. So just to kind of go back to the 15-minute 15-minute trade, the first 15-minute bar closed, and we did not overlap the close from yesterday. So that means it's a go. The only day I don't trade the 15-minute, for those that are new, is the a time where we trade at the close of the prior day within the first 15 minutes. So that means the first 15-minute bar, its high is 77.50, its low is 66.50. Those would be the two orders, the buy stop and the sell stop. So today we traded to the downside. I don't do any kind of second trade if the first break gets a plus 20. So like we broke to the downside 66.50 and then had this very, very quick move all the way to a plus 20 in one candle essentially. And so I wouldn't reverse it then, or like if we came all the way back up here to 41.77 and a quarter, I wouldn't try and get long at that point. I only do take the opposite side if the first direction is a stop out. So that was a fairly quick 15-minute, I would say. One thing you can do that I have done in the past, and um, if you've got let's say you have a couple of contracts on the 15-minute and you get your plus 20, if you leave one or two on and trail 15-minute bars from there, in some cases you can catch another pretty big move. Like if it ends up being a really big sell-off day, um, you can catch another 10, 20, 30 points sometimes. The idea there would be you've already got plus 20. Your stop is going to go above, if you're short, is going to go above the next 15-minute bar, which is going to put that stop inside a plus 20 briefly. But if the market keeps going, then you can, rather quickly in the next 15, 30 minutes, get your stop down so your stop is outside of the plus 20 and maybe catch, like I said, another 10 or 20 points sometimes. So otherwise, I don't really futz with the trade inside of the plus 20, with the exception of moving my stop to -4 when I get to plus 15. So see over here on the 512, this swing high never broke right here. And we rolled over and didn't get, had that hammer down here that I tried for a little long off of, didn't really get anything. And then rolled over. So that swing high. The swing highs and lows, just looking at especially if you're newer to trading, keeping it as simple as possible. Looking at the prior day's high, low, close, basic support and resistance levels just based on things like that, the prior day's high, low, close, where we spent time trading earlier in the day. So if we spend a lot of time in this kind of sideways price action like this, that could end up being a resistance point. And then, so you see like these lows here are the bottom of the rectangle. As we get all the way over to the right side of the rectangle and you see this inverted hammer, that's now it's underneath. See how this 1, 2, 3, 4, 5 bars are underneath the rectangle, underneath the prior resistance, or the prior support, which then becomes resistance. So basic stuff like that. You don't have to overcomplicate it. Trading, especially when you're actively trading every day, there's enough curveballs and things to manage already that you don't need to make it more complicated by having a complicated strategy. Here's the 50% just from this most recent move here. So ending up being a pretty bearish day so far to the downside. If you search 15-minute breakout on Emini Mind or just scroll down on the home page, I've got a write-up on kind of the parameters I just mentioned, along with a video that walks through that trade setup. Next week, I was asked to do a guest webinar on the 1-minute chart, trading the hammers and inverted hammers. And then all of these Tuesday sessions are recorded as well. So if you scroll maybe halfway down in the members area under live trading sessions, those are all in there. And you can go back like 10, 12 years and I don't know if you'd really want to do that, watch all those videos, but they're all in there. So if you miss a Tuesday session, um, it gets recorded and put in there. And sometimes it's just helpful to go back, especially on a day where you were trading. I like to compare my trades at the end of the day when I'm reviewing, like put some space between when you're done trading. Let's say you finish, after a couple hours in the morning, and then get away from the screen, come back in the afternoon or in the evening, and just kind of go through and summarize your trades or review the trades that you took, and then run through the day again really quickly now that you've seen what happened. And I guess it's less about looking at the outcome and more about, okay, let me run through the day again and run through my same process. And now that I'm not actively in a trade, let's pick out, just run through the setups for the day as I'm looking at it kind of in hindsight, if you will, and just kind of compare. Okay, yeah, if I go look at the chart here, let's pretend it's now 5 in the afternoon. Oh yeah, here's a couple inverted hammers here, and then you kind of go in. Oh, why didn't I take the 648 one? Oh, okay, let's see. Oh, you know, uh, just compare your notes from earlier, and or maybe you took a trade, and then when you're going back and reviewing at the end of the day, it's like, why the heck did I take that trade? That does not look like a good setup. And you can kind of help create or shape your intuition so that you can say, okay, yeah, these two were good trades. We had high ticks, and yep, those were trades that I either took or didn't take, and start to build more familiarity around the setups, and that just helps build confidence. So, and the nice thing about day trading is you get a lot more frequency of trades to review, whereas if you're swing trading or taking a couple dozen put hedges per year, you only have a couple dozen trades to review at the end of the year and kind of in your data set. So the 15-minute breakout, as far as winning percentage, is going to be a lot lower than like the retracements. But when you plug in, so if I go to last year, so you're down in like closer to 40%, 41 I've got here. I'll go further back. Yeah, 40, 41, 42%. However, when you plug in an average winner, that is 20 points, and an average loser that at times can be fairly big, um, but it will start to, like, you can't just look at the winning percentage, I guess. So, but at the same time, you know that you can get away with a smaller winning percentage when you have such a big profit target. And I guess I should say we made a little change last year in the 20-point target, how I managed the stop on the 20-point target. So that winning percentage is probably a little bit higher. Um, it's certainly higher now, slightly higher now, and also the average winner is higher. Um, I'm sorry, the R multiple, like the winner over the loss, is a little bit higher because early on I was trailing my stop, and so my average winner was a little lower because some of the winners weren't 20 points. So if you look at the data of your winning percentage and losing percentage, but winning percentage gives you the loss, one minus winning. And then so winning percentage, average dollar winner, average dollar loser. Then you can come up with your R multiple, which is your reward to risk in a ratio form, so your average winner over your average loser, and your expectancy, which would be like on average, if I take all my winners and losers, what's my average trade? And that's kind of the most important one. How much can I expect to make on average with um, with this individual trade? So knowing that, I mean, you could have strategies that give you, closer to like a 70% win rate, but when you factor your average winner and your average loser, the dollar amount that you might end up making per trade is a lot of times much lower. So looking at all those together, you can kind of base or come up with you can kind of compare strategies together, I guess. Looking at your expectancy, you can look at your expectancy for multiple trades or multiple trading strategies, and then you can compare them side by side. If you just say, oh well, the winning percentage on this strategy is 30%, and the winning percent on another strategy is 70%, well, a swing trading strategy is going to have most likely a less than 50% win rate. But when your winners are, 5, 6, 7 times your losers, you can be expected to make a lot more profit um, over the long run. So, and I do have a video in the dashboard on that as well called expectancy and R multiple. That's a really good one that runs through those exact calculations and how you can use them. And you don't have to keep a super fancy trade log. I mean, I know there's a lot of online ones out there that pull in your trades right from your trading platform, but um, you can certainly get away with Excel. That's what I've used for 15 years. Just keep it super simple. A column with for a few notes and a few basic data points, and that's really about it. You know, if you write down the time, your entry price, and a note or two about what you saw at the time of entry or the reason you wanted to get in, you can go back and fill in like your how much heat you took on the trade and the max profit and some of those other things that are helpful, but you don't need to record the very instant you're placing a trade. Going back to the 15 minute for a minute, when you get that plus 20, we were talking about trailing your stop from there. So you would have your stop trailing the next 15-minute bar until the next one closes. So usually you have to wait for an entire candle to close and then the next candle to form and close before you're moving your stop into a larger than plus 20 amount. Like I would leave my stop above the candle that's closed until the next candle completely closes. So you got another 9.5 minutes. But that would be the idea behind trailing your stop beyond the plus 20. And when I went through all my trades over the last couple of years, that plus 20 was a really nice sweet spot. Gives you a sizable profit, but also is not completely unattainable when the ranges are smaller. A 20-point move in the ES is not very big, even when the VIX is down in the mid to low teens. It's a little slower to get there compared to when volatility is up, or on a day like today where you get candles that are 23, almost 24 points. But all in all, it's pretty solid. So not really getting too excited about any of these retracements down here. I mean, you can certainly take a stab at any 50%, but for me, on a day like today, it's just a little bit more about conserving the mental capital along with actual capital, but kind of coming out of the day on a really positive note with a nice 15 minute, and then the puts, it's like how much more do you really need to eke out of the market? You don't have to use the nicey tick. That's just kind of like a bonus. But on the 1 minute chart, make sure that the candles that you're trading are either hammers or inverted hammers. The one exception would be if you draw up a retracement and that candle is lining up with a larger retracement. It may be a spinning top, which is kind of a reversal candle. And a spinning top would be when you have um, like the topping tail. So this guy here, you've got this green candle, and then this one, you have a tail above and below that's maybe close to symmetrical with a smaller body in the middle. So some type of candle like that forming right at a 50% is okay to take. Otherwise, shoot for just hammers and inverted hammers, because like even the one down here that I took a stab at, you know, it was a hammer. You had a couple of bars where it moved up, and you're able to tighten the stop, and you end up with just a small loss. You still got momentum. The trade still went your way. I mean, it's very rare for one of these 1 minute candles to kind of, if you get long, set up in a bearish engulfing pattern and rip right through a full stop. I mean, it does happen, but it happens infrequent enough that your risk is extremely reduced. And then also when you get days like this where it's just a complete slide to the downside, um, not really worth at this point trying to take a counter trend trade. At some point there will be a bounce and it will be bigger than just these couple of points, kind of more of a bear flag. But you run into, like early on, it's okay to try taking a reversal, but then when you see low tick after low tick after low tick, it's just you're going to get that low tick on the nicey, and then you're going to get a new low price, and then a low tick that lines up for 10, 20 seconds, and then a new low price. So then you just end up catching a falling knife, even like down here. Like this candle is not a perfect hammer, but it's kind of got a longer tail to the downside. And you start to see some of those um, when you're getting a bit extended, but more than likely um, when the market's, I mean, this is a pretty sweet downtrend here. So there's not really a need to try and pick the bottom. When you get a low nicey tick and then it's followed by a low price, that would be a tick divergence, and you would expect the market to continue lower. It's worth paying attention to the time. We're kind of in that time period where you would expect a bit of a bounce, like kind of about an hour in, maybe a touch after an hour in. We do have a little swing high break here too. So this is probably the most likely or best opportunity for the market to bounce. The swing high break, but still, that being said, um, you kind of weigh your reward to risk. And sometimes it's better to just sit tight. You can also look at the, I know I said the nicey ticks aren't needed, but notice in here you're coming up into a high tick. We're still way down at lows, but you could start to see a change in the tick trend. And so we've got a very sideways range in the nicey ticks, the zero line kind of being the top end of that range, and then minus 900, minus 1,000 being the bottom of the range. You could all of a sudden start to see like higher highs and higher lows in the nicey tick forming. So yeah, good questions today. The the nicey tick is if someone came to me and said, "Hey, I want to learn to trade the ES," I would say, "Okay, pull up a 1 minute chart in the nicey tick, or a 512 chart in the nicey tick." It is incredibly helpful. But if you break down the basics of like the simplest form of getting in a pullback, you want a break of a swing and a break of the opposing 61.8. So if the market's going down, then I want the last 61.8 to break. I want the 61.8 to break before drawing up a retracement in the other direction. So you want a break of the swing high if the market's going down, and a break of the 61.8 before drawing up a long if the market's going down. If the market's continuing, then I want the 61.8 to hold, and I don't want the swing low to break. I want to be looking at getting in when we come up to the negative 23 and we pull back to the next 50%, then that is the point where I want to get in and get in on the bounce. I wouldn't want to wait for us to come down like kind of where we are right now, where we're breaking the swing low. We broke the 61.8. Now that's kind of a sign that the uptrend is losing some momentum. So yeah, a day like today, that's the good point, Stan. That's the other one. So we've got the nicey tick that you don't have to use, but is really helpful. And then these two boxes here, the breadth and the advanced decline line. Again, you don't have to have them on your chart, but when you're not using indicators or cluttering your chart up with a whole bunch of, you know, Bollinger Bands, moving averages, not that those things are bad, but you're leaving the candles and the chart patterns to speak for themselves, then something like the breadth and the advanced decline line become extra helpful because they are showing you, okay, what is the volume doing in the NYSE? Well, we've got 8.5 times as much volume going into stocks that are moving down versus up. And then on the advanced decline line, that's telling you out of all the stocks in the NYSE, 2,000 are on net moving down, at least 2,000 are moving down versus up. So that's pretty bearish. When you get outside of like 3, 4 to 1 on the breadth, on the volume ratio, and when you get outside of like 1,000 on the advanced decline line, those are getting to be pretty bearish, and it's harder to reverse that train. If you think of like the train speeding up as the numbers get bigger, in order for that train to reverse, it's going to take a lot more braking power to slow down, stop, and turn around. So how can the market move up at all? Well, if the sellers dry up, or there's no one left interested in selling, or there's a lot more people interested in buying, and so they buy up all the orders that are sitting out there at 41.25, and then the next person that's interested that has a sell order out there is 41.26 or 41.25 and a quarter, let's say, and there's only 5 sell orders there, but there's 10 people that are interested in getting in at that price. Well, only 5 people are going to get that 41.25 and a quarter price, and then the next 5 are going to have to go up to the next order that's out there. And let's say there's 2 orders at 41.26. Okay, then 2 more people get that price, and then if the next order is 41.27 and there's only 1 order there, then 1 person can fill that price. So kind of the number of people that have sell orders out there and buy orders out there have to be matched to each other. And if you think of it like a tug of war, say you got 5 people on each side of the rope, and both sides are equally as strong, then if 10 more people come to one side, all of a sudden the market's going to swing that way. Um, I guess the breadth and the advanced decline line don't really show you the number of like buy and sell orders within that. Um, they're just showing you kind of the result from the orders. So if there's 2,000 stocks that are moving down, we don't know who's waiting or who's about to put in a big buy order. But if someone does start buying up shares, then those stocks that they're buying up shares of are going to begin rising, and then you'll see that reflected in the number of stocks that are moving up versus down from their last print. So if you get a whole bunch of a big buy order coming in, and it moves the stock up, then that's going to be one less stock that's moving down. You might be overthinking it a little bit, Stan, but yeah, in general, the volume and the number of stocks moving up and down is what the breadth has given us. Really haven't had much, even on the 1 minute, of little inverted hammers on this move down. I've been kind of watching for like a move up to get an inverted hammer to take the next leg down. The retracements are, in general, holding their 61/8 here, but oh, cool, Mike. Yeah, and if you're using, if you like Thinkorswim charts, someone told me that if you don't have, if you just pull up the Thinkorswim platform, you don't have a funded account, then your data is delayed. But I think if you just like open up an IRA and throw a few $1,000 in it, you can that should give you live data. Or just open a regular margin account and put a few $1,000 in it. That should give you live data. So I have most of my like investing accounts and stuff at well, it was Thinkorswim, then TD Ameritrade, now it's going to be Charles Schwab. So um, just kind of nice to have everything in one place. Oh, I got you. Cool, Mike. Yeah. I would, on the daily chart, um, now that we've made this higher high over here compared to where I've got the anchor, you're going to end up moving this retracement up here like this. And then what ends up happening is if we come down and break this swing low, the swing low is close enough to the 50 that you'll likely get a quick push. Like if we're going to trade down to the 50, it likely happen pretty quick because you get stops below this swing low, and then you can fall to the 50 really quick, and sometimes you can overshoot it a little bit. So yeah, definitely worth maybe taking a little bit of profit here at the close on the puts, and then seeing what happens on Thursday. And if we rally on Thursday, then I'll just close them all out and be done with it and take whatever profit I have. If we sell off again on Thursday, and I close the Friday ones and hang on to the Monday ones, and then wait till Friday's close to probably sell all of them, maybe keep a few. I don't love hanging on to options over the weekend when you got an expiration on a Monday. It's nice to buy you extra time for Fridays, closing them out on Friday, but there really hasn't been a lot of commotion over the weekend lately. It's been not a lot of gaps. Even for earnings, we had last week a couple of gap days with some earnings announcements, but these gaps in here were all filled, and then we've been trading pretty neat and tidy. So yeah, you don't have to go crazy with 50 trades in a day just to make some good money. But yeah, quite a bearish day. Very uncharacteristic of the Tuesday before the Fed meeting, but that's been the trend the last two or so Tuesdays before. You can't really fight the trend. Just trade what you see, and even if you don't think that should be happening or it doesn't make sense given there was a news announcement that came out or data that looked really bullish and the market's not going up, it's when you start fighting that it becomes bad news. Yeah, that's kind of an inverted hammer, not that great though. I like an inverted hammer or a hammer to have the body to be like a quarter of the candle, but that's the right idea. You get a bounce, sell below the low of the high bar. There's not a retracement in that little move, and then just start trailing each candle from there. So, and then as far as the 61.8 goes, intraday, um, just a break of the 61.8 is fine. You don't need a close outside of it. I like for a 2-tick break, and if it's an odd number, if the 61.8 is an odd number, round and then add your 2 ticks. But on the daily chart, a close outside of the 61.8 is important because you get situations where you're like chopping around and maybe you break below the 61.8 and then you trade back up into it. So the daily chart, I like to wait for a close. Intraday just needs a move above or below the 61.8. Let's see, 750 is hammer at 750. Yeah, I didn't really consider that one if you're talking about the inverted hammer stand. And then this one here is, I mean, that's closer to a better hammer. But again, that'd be doing the counter trend trades that not really been doing here on the way down. The one early back here. But after I take one counter trend trade, if it doesn't get any momentum, I'm not going to try and keep taking counter trend trades. So. But even as you just look at this overall chart, like your eyes are gravitated towards these little candles that poke up, the tails poke up above, that's the kind of stuff that you're looking for, like price rejection, as you'll hear it called. We had a gap down, that was the high of the day, immediate selling, and then you've got an attempt to go higher and then price rejected. And so the 15-minute perfectly doing its job today. And then if you want to trail a couple of contracts, even if you just have 2 contracts, that's fine too. Take one off at plus 20 and try trailing that second one. You can't take the second contract off for like 5 or 6 points. You gotta get to plus 20, and then trail it because you want at least 20 on that second contract. You start messing with um, more contracts and you feel like, oh, I've got 10 contracts. I'm going to take 5 off for 2 points and make, the numbers can start to get bigger. The dollar amounts can start to get bigger, but you still want to look in ratio and relationships of your reward to risk. If you're risking 2 points and you make 2 points, you're at 1 to 1. You risked 2, you made 2. So if you have 10 contracts and you feel like, oh, I'm going to take 8 off at a 1 point profit, yeah, you might have made 8 points, but you're at half to 1. So you're not, your reward to risk is not very good. So sometimes, I get folks that have plenty of capital to trade, and so they feel like, jumping in with 10 contracts is not really it would be a fine starting point, but you got to build some of that mental foundation first before you just dive off the deep end. There's no reason to take excessive risks, even if you've got excessive amounts of money, um, unless if it's just a game and you don't care about making money, then you can do whatever you want. But I'd venture to guess that no one's really in that boat here with just doing it for the enjoyment. You're trying to achieve a goal here. Well, on that note, I think we'll look at that daily. I think we'll call it a wraps. Pretty much textbook inverted hammer on the daily chart, gap down and go. I mean, yeah, it just screams buy puts when you get that kind of a move. A double top at a 50% into the Fed meeting. Like, I'm not going to load the boat and buy 100 puts, but um, certainly was a very low risk hedge, in my opinion. So we'll wrap it up there today. If you have questions during the rest of the week, you can always drop them in the Discord, and I can chime in and share screenshots and stuff. If you have other specific questions that you don't want to share publicly, you can always email me, Tim at Emini, and happy to chat there as well. So hope you have a great week, and nice job for everyone today. Good questions and good 15-minute, and we'll see what the Fed meeting brings tomorrow. Go do something fun in the morning and check back in the afternoon and see how it goes. So hope you have a great week, and I'll talk to you all soon. Thanks.